Operating a high-speed vehicle through dense fog without internal instruments guarantees a collision. You feel momentum, but lack data to predict the next turn. Retail traders routinely crash their accounts due to a similar paradox. They steer entirely by looking out the windshield, staring exclusively at lagging physical price bars. This chart shows a standard market sequence: a sharp upward run, a violent pullback, and a subsequent surge. Looking strictly at this physical action means you are interpreting data after the event has already happened. Relying on delayed optics creates distinct points of structural failure. Operators inevitably buy near the local top when the trend looks fastest, and they panic sell at the absolute bottom of the pullback when the drop looks most severe. Institutional execution requires a different perspective. Physical price action is merely the structural chassis of the market vehicle. It is the outer shell being pushed by a deeper mechanism. Predictive directional shifts do not originate on the naked chart. They build quietly in the engine room, driven by underlying momentum compression well before the physical price can react. To exploit the lag between internal pressure and physical movement, the DRW core flow and telemetry blueprint utilizes a 4-tier diagnostic sequence. Without first measuring internal engine compression, executing trades based solely on visual price patterns is a mathematical guarantee of failure. This split-screen framework outlines Phase 1. The top half monitors standard candlesticks, while the bottom introduces the sub-chart histogram tracking internal telemetry. The zero baseline defines the market's idling state. When readings flatline here, the asset is in localized shock, devoid of momentum compression. A wave A eruption interrupts this idling state. This is a massive build of raw hydraulic pressure violently forcing its way across the zero line. After an eruption, the market inevitably corrects. On the physical chart above, this forms a wave B pullback. During this physical pullback, operators must track a core metric, velocity decay. During true velocity decay, the underlying histogram bars shrink in size, proving engine RPMs are safely dropping off. The strict survival rule is placement. Shrinking bars must remain exclusively on the positive side of the zero baseline. This specific telemetry proves the primary combustion chamber remains fully pressurized. The physical price has dropped, but the internal momentum structure is intact. By confirming velocity decay, the operator knows the trend isn't dying. The market is simply inhaling, gathering compression before the next aggressive thrust. This brings us to Phase 2, where the trend structure is stress-tested against dynamic boundaries. We overlay the shallow 13 EMA and deep 34 EMA. The 13 EMA is a shallow injector. On aggressive trend days, price taps this line and instantly accelerates higher. The 34 EMA serves a different function. It acts as the heavy chassis floor, outlining the absolute structural limit of the trend. Retail operators view this 34 EMA floor as a solid concrete wall. They assume that if price touches it, the structure must hold perfectly. Algorithmic market makers rely on that assumption. They will intentionally drive the price below this exact floor to trigger cascades of retail stop losses. This visual sequence dissects a liquidation sweep. The physical candlestick wick violently spears below the boundary line to harvest localized liquidity. Institutional algorithms instantly absorb the selling volume. The candlestick rapidly snaps back upward, leaving a long lower tail. The strict validation rule is in the close. The candlestick body must solidify above the 34 EMA to confirm the sweep was successful. If the candle closes below the 34 EMA, the structural chassis has physically snapped. The logic is broken, and you execute stop-loss triage immediately. Institutional boundaries function as dynamic shock absorbers. They are designed to bend, trap the uninformed, and throw the accumulated weight back into the primary trend. Professional operators do not anticipate when the structural suspension has finished loading. Instead of guessing, the system translates structural alignment into visual proof. A C-wave diagnostic arrow prints directly beneath the pivot point. This marker only prints when internal telemetry from Phase 1 and structural sweeps from Phase 2 synchronize perfectly. Algorithmic validation removes human hope. The appearance of the arrow confirms the entire body of the trend is now physically pointed straight down the track. Massive, explosive acceleration occurs only when multiple independent metallic gears suddenly lock teeth and violently spin in perfect unison. Phase 4 triggers a terminal sympathetic response. This stage initiates only when multiple independent market architectures align simultaneously. This dual chart setup shows total synchronization. When the micro-execution 3-minute chart prints a diagnostic arrow exactly as the macro 4-hour structure aligns, the gears lock. Beside them, a depth of market column maps resting resistance blocks, initiating a liquidity vacuum. Total order book synchronization instantly obliterates resting ask liquidity. The resistance completely fractures under accumulated volume. The visual result is a vertical runaway price movement. Stripped of structural friction, the market climbs unimpeded. At this exact moment, you execute 2 rigid behavioral directives. First, you immediately stop trailing your stop losses tightly. Second, you abandon premature profit targets. Interrupting compounding institutional algorithms cuts your own yield. When true structural synchronization activates a liquidity vacuum, your job is to perfectly step back. Simply let the underlying market architecture floor the gas pedal and allow the autonomous financial machine to smoothly run to completion.